As we come to the end of the year, it's usually a time for us to reflect on the decisions we've made and also to chart a way forward in the future. So, for today's video, I'd like to take a look at three of the stocks that we would have highlighted in the very first inaugural issue of the Alpha Investor magazine back in October of 2023. And those three stocks are Walt Disney, PayPal, and Viva. Which are all pretty well known. Viva is probably the least well known, but it's essentially a well, not really a CRM, but a SaaS company that caters towards the healthcare space. Um, Now, at the time in 2023, all three stocks were down in the doldrums, and they've all recovered somewhere between 20 to 50% over the past year. And so I'd like to take a look at all three of them and possibly chart a way forward for the future as well. So when we head over to Fast Graphs, which is a really powerful tool that helps us look at the fundamentals of each company visually to understand, get a sense of value for each of them. We look at Disney stock, and you see that Disney has performed well for the past, well, prior to 2020, performed very well and outperformed the S&P 500. It went down considerably at the start of the pandemic, had a big run up during the pandemic, and then would have gradually eased its way down up until last year when we would have highlighted the stock as a possible buy at that time, right around this period right here, October 2023. Now, a couple things to look at in this graph is that we see that post the pandemic right here, this spike in the value of Disney went all the way up to $197 per share and a PE ratio of 92. Um, was, I guess, due to trading, because when you look at the fundamentals, which is the orange graph below here, we said that the fundamentals actually declined quite considerably. The earnings declined quite considerably right after the pandemic and would have increased thereafter. So there's a clear mismatch between the price and the earnings right here during this period. And so I think this is the region where the price of the company did not match its underlying fundamentals. And what we find that over the long term, price and value more or less come back into sync after minor periods of going haywire. So after this pandemic boom during the launch of Disney Plus and other features, we come to October 2023, which is right about the spot here. And if we compare it to where it is right now, just over a year later, you see that the total annual return would have been 34.04%. The total annualized return, I should say. And that is a pretty great return in the space of 1 year for a company that was really down in doldrums just about a year ago and has started to see the seeds of a revival with the introduction of or the return of Bob Iger as CEO and some other levers that they're pulling, for example, trying to get rid of some of the not so profitable legacy businesses. And we see a similar thing for a company called PayPal, which let me just bring up the graph here. Right, you see PayPal went through a similar spike during the pandemic, which was the stock price really outpaced the underlying fundamentals, went through a crash where people thought that the stock was, dead and buried. So from October 2023, when it was at $55 per share, and it's now at $88 and 76 cents per share, we see a total return of 59.21% and an annualized return of 49.27%. Again, not bad for a company that just a year ago was considered dead and buried. This, again, folks, is a reminder that the fundamentals of a company are what drives its long-term price. And so I'm not a trader, but as a long-term investor, that is what I look at. Now, the third stock that we're going to take a look at is Viva, which is probably the least well known of the three stocks that we analyzed or recommended in the inaugural issue of the Alpha Investor magazine. And all three companies, I guess, had the similar chart pattern where after the pandemic, they really shot up in value. Viva went all up to $332 per square, $338 per share at over 100 PE, and now it is down to $246. But we see that the PE ratio, or the earnings multiple, has come back to even below where it has historically been. And looking at the where it was here in October 2023, which is right about here, to present day, we have a total return of 22.86%, or total annualized, and a total annualized return of 19.76%. So again, this company went through a period of being very, very hot, very in demand, very in vogue during the pandemic, right around this region here, and then came back down to earth, as most things that go up do. They came back down to earth. But now that we see, now that the pandemic and really other related hype and the catalysts are gone, we see that the fundamentals have started to again drive the stock price. And as the fundamentals, the earnings increased over 33% in the past year, we see that the earnings power has finally resumed being the main driver of the stock price of Viva. So those three examples that we listed today, Disney, Viva, and what's the third one? PayPal, are examples of staying in the market long term and not being driven by hype. Now, if you're a momentum person, if you're a trader, it's perfectly reasonable and perfectly fine um, to buy these stocks during the periods when the prices do not match the fundamentals and you follow momentum. As long as, of course, that you have a strategy, you have a plan. I certainly have learned the hard way that I'm not a good trader. But so if you're like me and you're more long term minded in terms of your investing strategy, I think the key takeaway from all these three examples is that not to chase companies, and also to believe in the underlying company. If the fundamentals tell you a story that opposes what the market is telling you in terms of the stock price, you have to believe in the fundamentals over what the market is telling you. And you have to not be afraid to look silly sometimes holding on to a company that the market is selling. And in this case, most likely it was traders selling the stock after the pandemic related hype has faded, and believing in the underlying fundamentals of the company. Right, guys? So those are the three companies I wanted to highlight today, which we would have originally covered in the first issue, the October issue of the Alpha Investor magazine. So ranging in those three companies had returns ranging from 22% all of the way up to 55%. And so if you're curious about this style of investing, more long-term oriented, please take a look at our previous videos, and of course the previous issues of our magazine. We're going to put a link in the show notes below so you can take a look at it. And we have another issue of the magazine coming up soon, where we highlight a few more companies that we think are presently undervalued and have a certain level of quality, a certain a reasonably wide moat, where we feel comfortable that maybe again by this time next year in 2025, we'll also look back and say, wow, this company was really out of favor, but now has returned quite considerable profits for investors. So I'm hoping that we could do this again next year, and we'll be even more successful in identifying undervalued companies. So thanks for listening. Hope you enjoyed the video. Be sure to like, subscribe, and share this content. And remember to check out for all our free material and subscribe to our Patreon. Thanks for having us. And remember, this is really a lifestyle, and I hope that this was beneficial on your financial journey.